Hello, money and banking students. This week our focus is Chapter 18, Foreign Exchange and the Foreign Exchange Markets. And this slide gives some of the objectives that we'll be trying to achieve during this week. Also, I would encourage you to download the Chapter 18 notes that I provided in Moodle for you. They are fill in the blank and will help you as you prepare for the final exam. So what is foreign exchange and why is it important? Foreign exchange is the trading of different national currencies or units of account. And foreign exchange facilitates commerce between nations. For those of you who are international students or those of you who have traveled a lot in foreign countries, you know that when you typically go to a different country, one of the first things that you do is exchange some of your money into the local currency so that you can go to the marketplace and conduct business there. Of course, most merchants now take credit cards, and there the exchange would be done automatically for you. But still, having some foreign currency in your possession helps facilitate trade and make purchases when you are in a foreign country. You often hear in the financial news or the nightly news that the dollar has strengthened against the yen, or the pound has strengthened against the euro. When a currency appreciates, goes up in value, that means that it strengthens, and that allows one to buy more of other currency. That tends to increase imports and decrease exports because imports become less expensive and exports become more expensive. Conversely, when a currency goes down in value, it depreciates. That means that it weakens, and that basically means that it will buy less of another currency. And in that case, imports are going to decrease and exports are going to increase because imports now are more expensive and exports are less expensive than they were before. So in summary, when a currency appreciates or strengthens, we can buy more of other currencies. Imports increase. They're easier to buy. It's easier to buy foreign goods, and exports decrease. It's harder to sell domestic goods. And the opposite is also true. When a currency depreciates or weakens, we can buy less of other currencies, so imports decrease. It's harder to buy foreign goods, and exports increase. It's easier to sell domestic goods because they're less expensive. Here's a summary of the key takeaways from the first part of Chapter 18. Now I want you to have your Chapter 18 notes in front of you, and I want you to view this video. The link is also posted in Moodle for you. And as you view the video, please work through the foreign exchange problems as he is demonstrating those. At the bottom here is a table of the exchange rates that he uses in the video. After you complete watching the video, what I'd like you to do is look up the current exchange rates to the dollar for these currencies and rework the four problems using the current exchange rate. Hint, this is going to be part of our discussion for this week. So go ahead and pause the PowerPoint video now. Welcome back. I hope that little video and going through the calculation exercises helped you understand exchange rates and how they work and how prices are determined in alternate currencies. In determining the exchange rate, we want to answer a couple of questions. What is the structure of the foreign exchange market? Exchange rates follow a random walk because of free market efficiencies. And because of the randomness, exchange rates are difficult to predict. That's why Elijah, did a presentation on the Forex market. There's a lot of money to be made in Forex trading, but it's also very risky because of the randomness and because how geopolitical events and natural disasters and all kinds of things can affect currency exchange markets dramatically. Here are some terms to be familiar with. The spot exchange rate is the price of one currency in terms of another today. Forward exchange rate is the price of one currency in terms of another in the future. Trading is conducted on a wholesale basis by a few big international banks in an OTC market. An OTC stands for over the counter. There are a couple of different markets for the exchange rates. Wholesale market is where banks are trading currencies over the counter. Then you have the retail market, and that's for merchants, consumers who are placing exchange orders through banks, credit cards, and your airport kiosks. And then finally you have speculation, the banks who are trading on account for gain or arbitrage, forex markets, investors that are just trading on movement, direction movements of the currencies. We talked earlier about, when currencies appreciate or depreciate and what that does for imports and exports. A strong currency is neither good nor bad. Strong or weak currency is neither good nor bad, but rather it's advantageous for imports and consumers, and disadvantage for producers. Disadvantage for exports, producers of exportable goods. So it's good news, bad news situation with currencies. Also, the nominal level of the exchange rates in no way means that one country economy is better or stronger than another. Just because your currency appreciates doesn't necessarily mean that your country is better. It just means that goods are going to be priced differently, and the import and export ratio is going to change. However, changes in exchange rates, by contrast, have profound consequences, because, like we showed earlier, it can have a dramatic effect on whether the goods that your country is producing are going to be more expensive or less expensive for purchase, and that can affect your trade and your trade imbalance. On the bottom of page 3 of your notes, I listed the key takeaways from this section, and I decided just to print it out for you there rather than doing a fill-in-the-blank slide, but some pretty good information there to make sure that you review. Section 3 of Chapter 18, we are going to look at purchasing power parity and long-run determinants of exchange rates. If you're following along in your class notes, you should be at the top of page 4. The underlying principle of purchasing power parity is the law of one price, and the law of one price states that if transaction costs are zero, identical goods should have the same price no matter what unit of account that price is expressed in. Here are some long-run determinants of exchange rates: purchasing power parity, relative trade barriers, differential preferences for domestic and foreign goods, and differences in productivity. And here are some short-run determinants of exchange rates: expectations of future directions of price levels, trade barriers, preferences, and productivity all drive changes. So just forecasts and anticipated expectations of these things can have an effect on exchange rates. And again, that's one of the reasons why exchange rates tend to be very fickle. Additionally, future expectations on what interest rates will be, and even expectations of what future exchange rates will be, can determine exchange rates in the short term. Hope this little overview has been helpful. Make sure to read the chapter, do your quiz, and complete the study guide.